This recording will be on YouTube. All right. So I know when you joined, you just thought of when you joined our sessions, you probably, I don't know if it was a recommendation, but you just heard Ronald Kashweka. But actually, I don't do this alone. I can put it like I'm the person, I'm the voice. You get my point, Mr. Hendricks. I'm the person you talk to, but there are some other people who assist us with the IT and everything to basically ensure that all this is possible. Like personally, I'm not an IT person. So yeah, me, I just know stuff. You get my point, Mr. Hendricks. Okay. Yeah. All right. So this is basically more of RK Solutions. Welcome and thank you for joining as well. So today I'm going to break down capital allowances. I'm going to explain everything we need to know pertaining to capital allowances. I remember you mentioned you had a question. Your question was, how do we treat, do we claim capital allowances when we dispose of an non-current asset if we sell it? And how does it affect our capital allowances computations if we make a loss or if we make a profit? That was your questions, all right?
Yes, sir.
Okay, so today, right now, we're not just going to learn that. We're going to basically cruise through everything capital allowances from start to finish, and we'll look at those ones as well. So in accounting and basically taxation, capital allowances are deductions that businesses can claim for, wear and tear, which in this case represents our depreciation of, qualifying fixed or non-current assets. Okay? I'm saying qualifying asset because when you talk about a qualifying asset, we are looking at a non-current asset that has wear and tear, a non-current asset that loses value over time, a non-current asset that depreciates. Those are qualifying assets. Certain times people wonder, like, do we have non-current assets that do not wear and tear? Of course we do. We have, number one, we have intangible non-current assets, okay? Number two, we have some fixed assets, some tangible fixed assets such as land. Land does not depreciate, neither does it lose value over time, but it can be revalued if we were to use the fair value model. So land is not a qualifying asset, thus you cannot claim capital allowances on land. Okay? So in financial accounting, we record depreciation as an expense, okay? When we are calculating our profit, that means we are subtracting it. But in taxation, depreciation is a capital expense. That means it's taxable. So you have to add it back. So to replace depreciation, what we have instead are capital allowances, which basically represent more of reliefs. Okay? So in accounting, depreciation is not allowed for tax purposes. Instead, the tax authority allows capital allowances, which serve the same purpose of recognizing asset reduction in value, but using specific tax and rates, okay, or rather rates and rules.
Yeah.
Okay, so capital allowances is basically more of a relief. Okay, so capital allowances are reliefs, are non-current assets relief. So for the fact that you own a non-current asset that loses value through wear and tear over time, then you can claim capital allowances on those particular non-current assets. So in terms of taxation, depreciation is non-deductible, so you have to add it back and is taxed. But what is not taxed are capital allowances, which are basically reliefs that companies are given because they own non-current assets that lose value over time. So, but you might have a question. The question might be, why do capital allowances exist? Okay, why do they exist? Okay, so capital allowances. So the government actually introduced capital allowances to try and encourage businesses to, invest in productive assets, and also so as to replace accounting depreciation, which can vary. Okay, but capital allowance rates are fixed. Okay, and also to have a standardize how asset value reduction is treated for tax purposes. Okay. So for an asset to actually qualify for capital allowances, it must be number one, owned by that particular business. Number two, used in the production of income for business purposes, not for private use. Business purposes. If we talk about if you have a motor vehicle, if the motor vehicle you're using it 50% for private and 50% for business, then we can claim capital allowances on the 50%. Okay, and it also has to be a capital asset. When I say it's a capital asset, it means it shouldn't be trading stock. If you sell motor vehicles, then you don't drive them, so they're just parked. If you sell motor vehicles, then the motor vehicles are not your non-current assets, but instead they are your current assets as your stock. Okay, so if we talk about things like motor vehicles for delivery, office furniture, or machinery, all those are qualifying assets and they qualify for capital allowances. And then we talk about things like trading inventory, or basically just inventory. That's a current asset, not even a non-current asset. And land is a non-qualifying asset because it does not wear out. It does not experience wear and tear. So we have various types of capital allowances, okay, but I'm going to give you the common ones and I'm going to explain them, okay? So types of capital allowances. Types of capital allowances. So the first one is the initial allowance. Okay, is the initial allowance. So initial allowance, which is IA, so this is a one-time deduction in the year of purchase. Like you buy, like for instance, you build a building, okay, and then you want to claim capital allowances on that particular building. In the first year, you can claim the initial allowance and the wear and tear allowance. But for now, I'm just talking about the initial allowance. Okay, so we have the initial allowance, which you claim in the year of purchase. So this one is between 10% and 50%, mainly depending on the particular asset. And then the common one is the wear and tear. The common one is the wear and tear allowance. So the wear and tear allowance is the annual allowance for the remaining cost. This is the same allowance that actually represents depreciation. So wear and tear allowance is a capital allowance or a capital relief that replaces accounting depreciation. Okay, it's done annually, it's claimable annually until that particular claims all its value in. And then we have an investment allowance. Okay, so we have an investment allowance. So an investment allowance is basically more of extra deduction to encourage investment. Okay, and this is specifically for some sectors only. Okay, and then we also have things like industrial building allowances. So this is given for industrial buildings, hotels. It can be 5% per year, but it varies. That's why you don't really need to master the rates, but instead you just need to master how to use the rates. The advantage is that Zika actually gives you these rates in the paper, so you just check, and then if you know how to use the rates, then you'll be very, very comfortable. And then we also have farmworks allowance. Okay, and then we also have farmworks allowance. So these are basically for farm improvements, okay, or basically, improvements that you make on the farm, or some tasks that you make on the farm. Let's say, for instance, you dig a few things. Yeah, that's actually farm work, because maybe you are drilling something, or maybe something for irrigation. That's actually farm work, and it's usually 100%. And because it's 100%, you only claim it once. That's in the first year.
Right.
Yeah, and then there are also some terminologies that you need to understand if you want to be comfortable with capital allowances. Just a second, just hold. Just do this. There are also some terminologies that you need to understand. Okay, there are also some terminologies that you need to understand if you want to be 100% comfortable with capital allowances. Okay, there are also some terminologies that you need to understand if you want to be 100% comfortable with capital allowances. That's things like the cost. You need to understand when we say cost, what are we talking about? When we say income tax value, brought forward or carried forward, you need to be comfortable with it as well. When we say balancing allowance, or when we say balancing charge, okay, you also need to be comfortable with this particular term. So when we talk about the cost, we're looking at the purchase price, which is basically directly related to the cost of, let's say, installation or delivery, everything, and then the total acquisition cost, the total cost of us acquiring a particular non-current asset, or the total expense. That's what we refer to as the cost. So capital allowance is actually calculated on the cost. If they say 20%, is 20% of the cost. Even if it's in the following year, it's always on the cost. So if we were to look at it in terms of depreciation, it's actually more of a straight line, unless otherwise. You get my point, Mr. Hendricks?
Yes, I'm getting you, sir.
Okay, and then the income tax value, this is basically the cost minus the capital allowance. Okay, so firstly we have a cost. Let me just give an example. Let's say, for instance, we have a cost of 50,000. Okay, let's say we have a cost of 50,000. Okay, and then our rate for capital allowance as per our manual, or our basically whatever Zika information has given us, is 20%. That means our wear and tear will be 50,000 times 20%. To be like this, and then we're going to do 50,000. I'm going to make it a negative 50,000 times 20%, giving me 10,000, and then I'll close it up. So when I subtract my wear and tear, this is my capital allowance, by the way. I'll bring the capital allowance here as 10,000. So here I'll just say capital allowances. This is the format, by the way. Okay. So I'll bring my allowances here, this side. I'll bring it as 10,000. So capital allowance 10,000. So when I subtract the capital allowance claimed already from the cost, I'm going to get the income tax value carried forward. Okay, so my income tax value carried forward will be 40,000. Have you seen it, sir? So income tax value is the difference between the capital allowances already claimed and the assets purchased, or basically acquisition cost. Okay, that's what income tax value is. And then let's say this is year one, meaning the year we actually purchased this asset. That's why, it was like this. But what will happen in year two? That's the question. So year two will look something like this. Yes. Okay, so year two looks something like this. Instead of us starting with our cost, we're going to start with our income tax value brought forward. So our income tax value brought forward will be the 40. Are you seeing where I'm getting the 40? Because the income tax value brought forward is the income tax value carried forward for the previous year. You get my point, Mr. Hendricks?
Yes, I'm getting you, sir.
Yeah. So now that we have the 40,000, we're going to bring in the wear and tear allowance. So the wear and tear allowance will be the 50,000. I'm still doing it on the cost, by the way. Like I said, every single time you do it on the cost. Multiply it by 20%. It's going to give me 10,000 again, I know for a fact. And then it will be 30,000, that's the income tax value carried forward. And then here I'll have 10,000, that's the following year. So basically, I'll continue doing this because it's 20%, meaning I'll do it for 5 years. So now this asset can only claim, I would say, capital allowances for 3 years more, and then that's it. Have you seen it, sir?
Sir, yes. Yes.
Okay, now imagine this. In year three, this happens. In year three, we sell this non-current asset. So we dispose it off at, let's say we dispose it off at 70,000. Let's say we dispose it off at 70,000 kwacha. So this is what we're going to do. We're going to bring in the income tax value brought forward. This is in year three, by the way. So we're going to have 30,000 here. And then I'll bring the disposal proceeds, the money we've made from the sale. So the disposal proceeds are 70,000. You've seen the 70,000, sir?
Yes, I'm saying.
Yes, but it has to be restricted to the cost. We acquired this asset 3 years ago at 50,000 kwacha. So here, instead of me putting 70, I'll only put 50,000. It has to be restricted to the cost. It has to be restricted to the purchase cost. And then I'll find the difference between the two. We actually made a profit, I would say, because we sold it a little bit more than the income tax value. So we're going to have a balancing charge. So a balancing charge is what we get when our disposal proceeds is more than the income tax value brought forward, because it basically shows we've made a profit. We've sold that particular non-current asset at a price higher than its tax value currently. You get it, sir? So this balancing charge will be a negative, and it's going to reduce the capital allowances. Are you getting it, Mr. Hendricks?
Getting you.
Yeah. So it's a negative, and it's going to reduce the capital allowances. Okay. But imagine this didn't happen. Imagine in year three, we actually sold it at 15,000. We actually sold it at 15,000. Then we are going to have an income tax value brought forward as 30,000. We're going to have our disposal proceeds. But the disposal proceeds, what are we going to put here, Mr. Hendricks?
The what? Yeah?
The disposal proceeds, what are we going to put here?
The cost of the machine.
No. The disposal proceeds, we're going to put the selling price. We sold it at 15,000 kwacha. Imagine now we are no longer claiming allowances because we've sold the non-current asset. So the first example is we sold it at 70,000. We got a balancing charge because our disposal proceeds, which is the sales price, is higher than the income tax value brought forward. And then here, the disposal proceeds is 15,000. 15,000 is way less than the income tax value. You get my point, huh? When I said disposal proceeds, I'm talking about the price we've sold it at. Okay?
Yeah.
All right. So we're going to have 15,000 here, but we've made a loss. So this is a balancing allowance. Okay? A balancing allowance will act like a capital allowance. It will be a positive. It will increase the value of our capital allowances. So a balancing allowance comes up when the disposal proceeds are less than the income tax value brought forward of a disposed of non-current asset. A balancing charge comes up when the disposal proceeds are way higher than the income tax value brought forward. Okay, so when it is a positive, it is a balancing allowance. When it is a negative, it is a balancing charge. When it is a positive, it is a balancing allowance. When it is a negative, it is a balancing charge. A balancing allowance increases capital allowances, thereby reducing your taxable profits, your adjusted business profits, because you're going to have more capital allowances to subtract. But when a balancing charge decreases your capital allowances, meaning you're going to pay more in taxes. Okay, so basically this is the foundation that you need to know pertaining to capital allowances, and then everything else is just practice. Okay, so there are common mistakes that students actually make when it comes to capital allowances. Number one, you can say something like, for instance, claiming allowances for non-business assets. If a particular non-current asset is not wholly or exclusively for the purposes of the business, then you should not claim capital allowances on it. And then also forgetting to deduct the initial allowance before wear and tear allowance. If a particular asset qualifies for wear and tear, investment, and initial allowance in the first year, then please do claim all the three. Okay, and then also using accounting depreciation instead of capital allowance in tax computations. Okay, and the last one is ignoring balancing charge or allowance on a disposal. That's actually a very important part of capital allowances that you have to make sure you put into consideration.
So, Isa,
Yes,
is
Mr.
it
Henry.
okay for you to just show me through the past paper to do that disposal?
It's actually the same way. What I've done here is the same thing. It's the same exact thing. The only difference will be in the paper they'll say this was sold, which I was literally typing here. There's no difference at all. They'll just say it was disposed of at 70,000 and the income tax value is this.